Hey Derek, thanks so much. Well, now to Money Tuesday, and today we are talking about bonds. How risky are they? Are there better options for your investments? The man who gives us his advice all the time is Stewart Welch, and he joins us once again today. Hey Stewart.
Good morning, Jen.
Good to see you. Let's explain bonds first of all.
Okay, so bonds, let me start with stocks. If you buy a stock, you actually own a piece of a company. With a bond, you become a lender. So if it's a corporate bond, you're actually loaning money to a corporation. If it's a federal, like a treasury bond, you're loaning money to the federal government. If it's a municipal bond, you're loaning money to a municipality. And what you're really saying is I want you to pay me interest on my money, and then at a certain period of time defined in the bond agreement, I want my money back. And so you're a lender. Okay,
so you had a question.
Yeah, this is from a viewer.
Yeah, from a viewer.
A viewer came in, and we've been talking about bonds. We talked a little bit about them last week, and they said I was too general, and was because I thought bonds were potentially in trouble.
Well, she says, are you suggesting all bonds are headed for trouble?
All bonds are headed for trouble, and she said, does that really mean all bonds? And what you really need to understand is what we've had is a bull market in bonds. So interest rates have been coming down over the last 10 years, and that's actually been beneficial to bonds. So when interest rates drop, bond values rise, and the inverse is also true. As interest rates begin to rise, bond values begin to drop.
Okay.
So we're at historical lows. We got a 10-year treasury at 1.65%, where historically it's above 6%. And it could go a little lower, but the biggest risk is that interest rates begin to rise. And if they do, whatever bonds you own are going to begin to go down in value.
So what's a person to do?
So I think particularly the conservative investors, you want to pay attention to your portfolio and look at the bonds in there and be prepared to go to shorter maturities and higher quality. That's where you're going to be the safest in bonds. And so you're really looking for, I think in this environment with bonds, a return of your money, not a return on your money. And if you're looking to make money in this market, I think the place to be is going to be in stocks. And what I like is the big blue chip companies that are paying dividends. Right now you can get dividends averaging around 3.5%, 4%, which is a lot better than what you're getting in bonds.
All right, you had another question. A woman says, I'm the beneficiary of my husband's IRA. If he dies before age 70 and a half, can I just leave the funds there but change it to my name and add a beneficiary?
So 70 and a half is kind of that, once you turn 70 and a half, you have to start taking money out of your retirement account so the federal government will get their money. The answer is yes, she can take the money and roll it over, even if the husband had begun making taking distributions. And he dies that year, they still have to take the full distribution required, but after that she can roll it over to her own account and postpone taking distributions until she turns 70 and a half.
All right, as always, you can get some more information from Stewart Welch, and his Stewart Welch website is?
Welchgroup.com.
Welchgroup.com. Thank you, sir.
Thanks, James.
All right, now let's go to Mike.